Hi everyone, my name's Emmanuel. I'm with The Conduit and I lead the program team here. We're delighted to bring together two communities for tonight's event, the Conduit community and the Moral Money newsletter community, to discuss the state of the world. It's a big topic, but we'll do our best to address it. So in terms of tonight, before we get started, I just want to cover a little bit of housekeeping. You might be very familiar with this already, but just for those who are or might be new to Zoom, I'm just going to go over some of the basics. If you do get disconnected at any time, you can use the same link that you used to join now to reconnect to the session. It will take you right back here. If you have any questions, and we do encourage you to ask our panelists questions, you can do so by typing your question in the Q&A box. So if you click on the little Q&A item icon below at the bottom of your screen, it will open up a box and you're able to type in your question. You're also able to upvote questions. So if you see someone has already raised the question that you wanted to ask, you can upvote it, and that will let Billy know that there's a high amount of interest in the question. And then finally, this session is being recorded. So if you have to jump off early or if you miss parts of it, you can catch up later on, either by going to the digital library if you're a Conduit member, or by going to our YouTube channel if you're a More Money newsletter reader, and we'll have the recording up in the next few days. So without further ado, it's my pleasure to introduce tonight's moderator and facilitator, Billy Nauman. Over to you, Billy.
Thank you, Emmanuel. Thank you. And thank you to the Conduit for having us. We've had a great relationship with the Conduit and Moral Money, and excited to do another one of these events. I'll start tonight by introducing our panelists. We have with us tonight Bernice Lee, the Executive Director of the Hoffmann Center for Sustainable Resource Economy at Chatham House. We have Carolyn Simmons, Chief Investment Officer of the UK at UBS Global Wealth Management. And we have Amit Bouri, the Chief Executive Officer and co-founder of the Global Impact Investment Network. And, you know, I think what's really great about this panel is we have, you know, three very great complementary panelists that can talk about this topic that is so broad in many different ways, and really give us a good sense of the state of the world. Amit made a joke on Twitter earlier this morning that it's such a small topic that, you know, we'll maybe stretched for time in terms of how we fill it. But, you know, I think the best way to sort of think about the state of the world is obviously, you know, where we are now, where we need, and then where we need to be and how we get there. Those are sort of the three kind of main topics I think that I would like to cover today. And, you know, at Moral Money, we've been writing a lot about, you know, sustainable investing, ESG, impact investing, and sort of the role that private capital can play in building back better. We got that term from a Conduit event, actually, with Richard Curtis that my boss Gillian Tett did a few months ago, and it's really taken off across the globe, you know, spread wildly since then. And it really is, it does sort of kind of epitomize what we need to figure out, because, you know, I think we can start by saying the state of the world is not great. I'll let Carolyn kind of expand on that first a little bit more, but we do have to really look at all of these problems that we're facing, and, you know, climate and social unrest and inequality and, you know, racial discrimination, and think about how we change that, and how we can use, you know, the tools we have at our disposal through investment, through engagement, or whatever it may be, through philanthropy, you know, impact projects, and how we change that. So without further ado, I'll start with Carolyn, and I think you can give us a pretty good sense of where we are right now, at least from an economic perspective, and just love to hear your thoughts on, yeah, the state of the world.
Sure, okay. Hi everyone. So we're actually in an economic recovery at the moment, following clearly a very deep recession, a relatively short-lived recession. The economy's globally pretty much troughed in April, and we've been on a rebound since. That rebound's being driven by a few things. One's the opening up of society as the full lockdowns are being unwound. The other is the consumer. The government's put so many stimulus packages in place to protect the consumer from unemployment but they weren't spending. So they had income coming in, but they weren't spending. So the household savings ratio has gone up dramatically. And one thing we know is when people have money, they spend it. So consumer spending is now going up as well. And then, of course, the backdrop that underpins all this, of course, is the huge central bank and government stimulus that we've got. And just to put things into context, sort of the GDP number, the growth, or should I say contraction for the UK, for example, for this year is expected to be about 10% for the full year. And most of that contraction is in the first half, the recovery is in the second half. And next year, we think GDP will grow in the UK by about 7%.
Great, thank you. That's great context. So we, as you mentioned, we have bounced back from where we were. Thinking about it from a markets perspective and a macroeconomic perspective, you know, is that, I think this is a good segue into you know, sort of the sustainability and you know, impact investing side of it, because how do we make sure that those gains in the markets translate to gains for people, for working class people, for everyone, and not just the people that own stocks or bonds or are so lucky to still have a job? I mean, the unemployment numbers here in the States are still awful. And Bernice, I know you're very well versed in the sustainability world. I'd love to get your thoughts on the state of, you know, of that industry, sector, sphere, whatever you want to call it, and kind of what we're working with in terms of levers we can pull to help translate that rebound into gains for everyone.
Well, thank you very much, Billy. And this is not a really, really small question at all, of course. I was going to say, well, to be honest, it would appear that looking back at this rather strange time we are still in the middle of, that where market incentives align with the sustainability agenda, we are doing okay. So what do I mean by that? What I mean by that is, for example, if consumers can buy our way into betterment, it would appear that Tesla, as you might have covered it already in your writing, has sold 20,000 more cars than they thought they would in the first quarter. Bike sales have gone up, meat consumption has gone down, production also disrupted. The meat industry lost about $20 billion, etc. So where there are market incentives and where sustainability agenda align, we seem to be okay right now. Now, what the problem we have is that where those don't align just yet, such as deforestation, for example, you will see that, well, actually the numbers there are not looking so great. So when we're looking at more forest cover loss, more tree cover loss, I think 70% more. I think, in fact, I read it in the FT not so long ago even, in the last couple of months. And this is why it becomes extremely important to support what, for example, the UK government proposed yesterday about punishing companies who are actually having deforestation in their supply chain, because where we're not doing so well is indeed where we don't have the gap being covered between the market incentives and the sustainability outcome. We're also doing less well in areas we can't measure. So if we can lament over some of the issues around deforestation, but perhaps even harder to measure would be, for example, the social contributions of companies. And this is an area where it is much harder for us to measure progress, and we will need to do it much better and faster after COVID, because this is obviously, if nothing else, COVID also is a huge spotlight, obviously, on all the social issues, not just around racial inequality, but also in general inequality that you mentioned in your introduction. So where we actually get measurements right will determine how that piece of the sustainability agenda will move forward, looking forward.
Great. Amit, I'll turn to you next. And I think you are one of the top experts on measurement. She mentioned measurement quite a bit. And I know that's a key part of what you do at the GIIN is setting up, you know, how investors can see what their money is doing when they put it into projects that have a social or an environmental aim in addition to an aim of making more money. And I'd love to get your perspective on, you know, what can we do to move forward, to build back better? What can investors do? What can companies do? And, you know, what sort of money is available and what's coming in to that sector with this aim of helping to improve these problems? And then how do they know they're getting what they are aiming to do?
Sure, no, thank you. And thank you both to FT Moral Money and to the Conduit for hosting this event. I'm really privileged to join all of you. I think a couple things that I'd start off with, and I may actually lead in with a couple of additional thoughts on the macro environment and trends.
Please do.
Building on what Bernice just said around, I do think one thing that's important to underscore is with this crisis, it has put a spotlight on the systemic inequities that we have within countries and also between countries. And we will see kind of an uneven recovery based on where people sit in that socioeconomic strata. I think another thing that is a trend that predates the crisis, but I think is an important one in this moment, is an overall declining trust and confidence in institutions, whether it be governments, businesses, investors, NGOs, and even the media. And I know you've covered this in FT Moral Money, but the Edelman Trust Barometer has been kind of a data source for the past few years that I've been very interested in. But these are some factors that we're contending with as we think about how we're going to build back or even build forward from this crisis. So with that in mind, though, I think what it really, the way that one of the things we need to focus on as we think about how do we move to the next normal, whatever, we're not returning to the last normal, but we are going to be in a different world going forward. It's really about, one thing that'll be really important is to demonstrate like real results. So companies, governments, NGOs will really need to have an ability to demonstrate the real progress that they're driving for people, for communities, and for the planet. And I think one thing that is very top of mind for us as a very positive thing is that we have seen a huge surge in interest from more mainstream investors who are interested in impact investing for where they weren't before. And I think that is reflecting, and it's actually accelerating a trend we'd already seen, but it is accelerating at a really great rate. We had seen much more mainstream engagement from pension funds, global banks, insurance companies, wealth managers, and others who want to put their capital to work to have a positive impact on the world. One of the big shifts, though, is I think there's going to be a broader social mandate in many countries where stakeholders, governments, pensioners, corporate leaders, employees, customers, and so on will want to have an answer to the question of like, what is my money or what is my company doing to bring back our community and to bring back our country. And I think that will have a shifting social mandate that we've already been seeing, where there's a broader set of expectations for investors that do need to respond to stakeholders. And so that, I think, is a promising trend. But of course, the challenge for all of us is to make sure that lands in high quality investment opportunities that both meet financial objectives, but also achieve a positive impact. And luckily, over the past 10 years, we've seen an immense amount of progress in the impact investing community that has really helped to professionalize and mature the market. And now I think it's a real important moment of truth for impact investing. But can we make sure that private investment capital is channeled to those high impact opportunities that will help lead a sustainable, inclusive, and just recovery?
Carolyn, with that, I'd like to come back to you. In your role in global wealth management at UBS, what are you seeing in terms of client interest in impact, and even going beyond impact into ESG and SRI or whatever it may be, and then how are they sort of looking at the impact portion of their performance, coming back to you? Or what are they asking from you when they are putting money into these to show that they're both, performing financially and then performing on impact or whatever ESG metrics they may have set up?
Yeah, it is definitely an area that's been gaining a lot of traction in recent years. And echoing some of Amit's thoughts, it's a lot more broader based, the interest that we've been getting recently, not just a sort of subset of people. In terms of the trends, it's, my money's out there doing stuff in the world. I'm investing in companies. If I can invest in a company that is either doing good or is trying to change itself for the better, then surely that's, a better way for my money to be put to use, which of course we totally agree with. The way to really sort of manifest change, I suppose, to be a sort of active participator rather than a passive participator, is to engage in what we call engagement strategies, which are the ones where you are helping companies develop themselves better along the ESG lines, rather than just avoiding someone who's not particularly ESG high scoring and investing in someone who already is. Actually helping those transform that need to transform, I think, is the more powerful effect. And in terms of what the clients are looking for, I think it's usually still reassurance that by investing sustainably, they do not sacrifice performance. And it's something we've gathered a lot of data on over time. I think maybe a decade ago, when the investment solutions were not as broad-based, it may have been more difficult to prove that. But now we have so many more sustainable solutions available that actually you can show that the performance is the same, basically, between sustainable investing and non-sustainable investing. Very similar volatility levels, but actually the risk levels on the sustainability side are usually slightly less. So, for example, in this pandemic, the maximum drawdown that green bonds saw was significantly less. I think it was about half of what the drawdown of a normal corporate bond saw. And things like that, I think, are going to help persuade some of our clients who perhaps haven't quite bought into the sustainability side, that actually this isn't charity, this is making money, but also having a positive impact at the same time.
How when they put money into a green bond, how do you, it's pretty easy to show that the performance is the same as it would have been with a non-green bond, but how do you show that that green bond made any difference? I mean, Amit talked about trust, and Bernice, this is something I'd like to ask you about as well. And there is a lot of cynicism in the market around a lot of these products. I hear it all the time from editors or even people in the sustainability market about sort of the authenticity of a lot of these investment projects or corporate pledges. I mean, look at, we did a story last week on the year anniversary of the Business Roundtable statement on corporate purpose last year. And there is just a lot of skepticism that these efforts are for real. So showing that they're not losing anything on investment performance is great, but is there a way to show that, yes, this investment removed X number of tons of carbon or whatever the metric may be, and how dedicated are investors to getting that as part of their feedback from their wealth manager, from their financial advisor, or from whoever it may be?
Yeah, I think the most obvious area where you can see that direct feedback is obviously in impact, because it has to be measured very clearly for that. Engagement's obviously the other one where you're seeing how you're manifesting change. I do agree in some of the other areas it can be a bit harder to see exactly kind of what the positive angle is that the company is applying as a result of the capital you're giving them. But I think with the moves to sort of greater integrated reporting, more and more companies are reporting things in their company accounts about their supply chains, about their emissions, all sorts of things like that. That becomes more helpful. When we're selecting investments, obviously, we follow a sort of guideline of principles to do with sustainability that we think companies and or funds that we're investing in need to adhere to be able to sort of qualify for our sustainability criteria. And it's across a wide range of things. It's the environmental side, it's the social side, it's the governance side. And it is not about just sort of excluding areas that you think historically haven't been socially, beneficial or environmentally beneficial. It's really about manifesting the change, I think, is really the important.
Yeah. Bernice, I'd like to come back to you. You mentioned a couple things in your intro that I wanted to touch on, around some of these issues that are not so easily measured, whether that's social or whether that's, some of these environmental issues that go beyond emissions, that are, deforestation, biodiversity, stuff like that. And I think it all comes back and plays into that issue of trust that Amit was talking about, where, as a journalist, our mantra is trust but verify. And I think that investors are needing to do that as well, and companies are needing to do that as well. is that happening on some of these other sorts of issues, you know, social issues and the broader topics right now?
Well, I mean, it's an excellent question, because in a way, what we do know is that the trust in the institutional piece is extremely important if we were to move this agenda forward. Building on what was just being said, what we do know is that from this crisis, we have learned that just having data and an algorithm is not really going to get us out of the jam we're in right now. What we also know is that institutions can't be built in a day. And that means that we've got to invest in them. And if we have to invest in trusted institutions, that actually means all the components that you talked about just now that would actually get us to the place where impact investments are truly impactful and that every penny counts. So what does that mean? That means that we need to invest in the collaborative tissue that is actually what built trust and what built the possibility of a trusted and verifiable outcome that you're talking about. Now, there are issues, as you mentioned, that are at more infancy of that process, and that primarily relates to some of the social issues, I think. In some ways, on the environmental side, luckily, we have some science that we had a head start, and we are now building on top of some of the climate-related indicators using similar but related, not necessarily the same, but related methodology to build out different types of outcomes measurements around biodiversity, around deforestation, around all the other related pieces, whether it's water use, whether it's fertilizer use, etc., sustainable agriculture. All of that will become that particular set of institutional tissue, whether they're soft or hard together, that hopefully will get us to where we need to get to. So I guess my takeaway from this would be that, well, if you need to verify before you trust, let's invest in those institutions together with governments and other stakeholders so that you will have the vehicles that you need, so that when the crisis hit, and we know that it will hit, then we will have the institutional setup and the soft and hard tissues to actually support what we need to do to make sure that every penny you end up investing in actually counts.
Great. No, I think you're right. Amit, I'll come back to you, and I wanted to ask more about sort of more the nitty gritty of the impact investing space right now.
Sure.
And, you know, from your experience within your investor network, what issues are top of mind for impact? You know, in what regions are they deploying capital in at this time?
Yeah, absolutely. And just for those of you who aren't familiar with the network that I represent, you know, our network includes over 30,000 people around the world who are, you know, engaged in the impact investing community. We have a formal membership that includes over 330 organizations in just under 50 countries. And that includes huge global institutions like UBS, among others, big pension funds, insurance companies, wealth managers, and also boutique firms. Some that are 100% focused on impact, and they're based in the global north and the global south. Our members are active on 6 continents. What we found is that increasingly, you know, there is it's now hard to find a big bank or a big kind of institutional investor that's not at least starting to think about impact investing. You know, I've in the past, well, back when we could travel, in the last 12 months of my travels, they took me to, you know, places like Brazil and Argentina and Tokyo and Singapore, in addition to, you know, London, Netherlands, and beyond. And the one thing that was, you know, loud and clear is that, you know, more and more, you know, wealthy individuals and institutions are thinking about impact investing or are actively deploying capital. And our current size of the market is around $715 billion US dollars in assets under management. And what we're tracking and what we define as impact investments are investments that are made with the intention of generating a positive, measurable social or environmental impact alongside a financial return. So it's part of the broader movement around sustainability and ESG, but we're focused on the specific subset of those investors very deliberately driving positive impact. One of the big trends in terms of how the market's evolving, increasingly wealthier families around the world want to put their assets to work to have a positive impact. And we're seeing that pop up globally. So in Asia and Latin America, throughout Europe and North America as well. The other trend that we're seeing is more and more institutional investors who have been involved in kind of, I think the first phase was trying to avoid harmful investments. The second phase is really coming at an approach from risk management. So like, how does climate risk pose financial risk to my portfolio? And that's been driving a lot of the interest around ESG globally. Now the additional part is like, how do I drive positive outcomes? It could be a pension fund trying to drive positive outcomes in its region or country, but it can also be thinking about global issues. Like, how do I put my capital to work to help achieve the Paris Climate Accords or the Sustainable Development Goals? And we see money moving across sectors. The big categories are financial inclusion, food and agriculture, housing, as well as energy. And I expect that that focus on helping to invest and capitalize those kind of basic needs will only continue to grow as we see the world kind of focus its attention on driving recovery from this crisis.
Great. I'd like to remind the audience, please start sending in your questions if you have any. We would love to get to those in the next few minutes. If you've got anything, please send it our way. Building on what Amit just said, Carol, I'll come back to you. How can the investment market expand the amount of money available to impact projects? There's 750 billion, as Amit said, which is great. That's up significantly from last year. I think it was 502, if I remember correctly.
Good memory.
Yeah, I quoted it enough times in stories. It just stuck. But there's a lot more that needs to come in. I know there are campaigns in the UK. There's the Make My Money Matter campaign that's looking to mobilize pension assets to do more in impact. As a wealth management company, what are some of the hurdles that are there in terms of putting client money into impact funds at an institutional level or an individual level?
Yeah, I think just the first question first, in terms of getting the biggest sort of bang for buck, if you like, it's about moving the money that's already invested in something that's not sustainable. So rather than trying to get the incremental dollar or pound to go into sustainable investing, just move all the other investments that are out there, of which there are a lot, into the sustainability sphere. So I think that's the kind of quickest way to do it. It's also the way that demarginalizes sustainability. You don't want, like, this is my investment portfolio here, and then over here is my sustainability bit. It should become, over time, one thing. In terms of, some of the challenges around it, we need, obviously, the products available. And, I've already said the product shelf is much, much wider than it was. And I think it is, big enough now that we can build portfolios with it, which we couldn't do maybe 5 or 10 years ago. But that still needs to continue to grow. Some areas may need government incentive to get them off the ground. There are certain areas of sustainability that have higher startup costs than others. And, we saw that in this pandemic. A lot of the incentives that the governments were issuing were to sort of green projects, if you like. I think Europe issued about $45 billion actually to green sort of support during the pandemic, just in the last sort of 6 months. So that's very helpful. And demand, it's a supply demand thing. You need the clients, the financial companies to demand these products, and then they will build them.
Bernice, I'd like to get your thoughts on that same question. Sort of, what needs to happen from your perspective to boost the amount of money that is available for making positive change?
Well, thank you. I mean, I was just thinking that if you think about, I think Vivid Economics did an excellent index looking at all the green stimulus and how green is the stimulus, and it's talking about, I think, 3.9 out of 9 trillion or something that is actually on environmentally sound product. And that actually dwarfs the kind of money we're talking about in the private sphere, which means that I can go back to the point that I tried to make earlier, again, to emphasize again, just why it is extremely important that investors, whether impact or not, have to support the drive of policies and politics and other soft tissues and institutions that will actually define the realm, that will actually help us direct a lot more of these investments into the sphere where would be more impactful. So it is wonderful to see so many impact investing initiatives and funds and others coming online and making an impact. But also, more importantly, we have to remember that for us to get us into the right direction, we need to align those with the big guys, with the big money that is now floating around in such a way that we're not wasting the stimulus, we're not wasting the penny that you have and others have. So that means, as I said, that I feel that the really important point is for us to double down on some of the soft tissues and investments in the stuff that perhaps is less glamorous in the real world, you know, such as the metrics and the measurements in accounting. But without those, we really can't really look at the scaled impact that we have been wanting to see.
Yeah. Bill, if I could just jump in, that really resonates with me, because I think, you know, with a mandate of taking on a topic like the state of the world, we're you know, by design, we're talking about big systemic issues, you know, things like climate change and inequality. And those are things, you know, to Bernice's point, they won't be solved by private investment alone. And, you know, and government is a huge driver, both in setting the rules of the game, but also in helping to drive capital and steer it. I think what really led to the genesis of GIIN, and what why Bernice's comments really resonate with me, is that we were actually started in 2009, so right coming out of the last financial crisis, with a mandate that came from a recognition from a number of stakeholders, foundations and investors, and some government backers who recognized that, you know, philanthropy and government alone wouldn't be enough to address these systemic issues if we didn't change the way that private capital flows. And that's really why we were created, and really spurred a lot of activity on impact investing around the world. But I think Caroline's point is also really critical in that we can't just have an impact investing grow in a niche and have the rest of the capital, or sustainability for that matter, but we actually need impact and sustainability to become part of all investing, where it's just part of how we think about things like value and performance and fiduciary duty, and these are really just built into how the system operates if we truly want a sustainable system. And the last point around the softer tissues, as Bernice speaks about it, you know, I think in many ways that resonates with me, because the GIIN as a network, that's part of our mandate, and part of what we do is really help to create public goods like Iris Plus, which is the impact measurement and management system we offer to the market. It's online, it's free, and it allows investors to convert their goals and intentions into real impact results. But all the research that we do among many other partners on the market is really helping to foster the development of an ecosystem and a marketplace that will steer much more capital to the impact that the world needs from it.
Thank you for that. That is very important perspective. And Bernice, I think you're right on. And I'd like to kind of unpack a little bit more about, you know, the soft tissue and the role of government spending in the recovery and in building back better. And I think that it does kind of dovetail with something Caroline was speaking about with engagement. Here in the US, at least, you know, so much of government policy is driven by corporate money. It's driven by corporate interests, lobbyists, and political donors. And, you know, I think a lot of the opposition that you see to regulations like you might have in Europe around carbon taxes or climate change are stymied here in the US, largely due to very deep-pocketed interests pushing in the other direction. You know, as part of a investor or a company or someone with power, with money and the power to change things, when it comes to their engagement actions, and I'll throw this up to the group, when it comes to their engagement actions, it's one thing to vote your proxies. It's one thing to put pressure on a board of a company to change. You know, should that also be extended to pushing for sustainable change at a government level through lobbying, through you know, donations, through whatever it may be, whatever levers of power you have available, supporting candidates that believe climate change is real over those that claim they do not. How far should, you know, private investors, private companies, or public companies, or whatever, go in terms of engaging on these issues if they're serious about making a real change? Anyone, go ahead.
Well, I mean, this morning I was just reading about the oil producers of Canada lobbying for relaxation of rules during the pandemic for approval processes. And you see this not just in Canada, but also in India, in Brazil, in South Africa. And there are lots of articles being written now as environmental regulations are being relaxed or taking a slight break during the pandemic. Now, this goes to answering your question, which is how far are you willing to go, is how far do you want to wake up tomorrow morning and make sure that your government isn't turning back on these regulations and making sure that every penny counts. And that actually means that you have no choice but to be a political participant in this. Now, it doesn't necessarily mean that you have to become a politician, depends on your predisposition, but I certainly believe that it at least means that you need to vote. If not, you need to support the sort of politics that will indeed get us to where we need to get to, because if you don't get there first, someone else will, and will ask for relaxation of environmental social standards. And once that chain is set, as we have seen in certain countries, it becomes much harder to rebuild those tissues. And those tissue means that if, as an investor with the power to support stronger policies and stronger regulation, raise their voice and let it be known that people who make money as a living, to make a living, believe in so, will help us actually change some of the parameters. And this is where the soft and the hard tissues, the wet kind of, sorry, I think we may be in danger of expanding this analogy a bit too far, but nonetheless, how these could be, the intersection of these tissues could create that web of trust that we were talking about. And I see there's a question as well from Laura Kelly that was asking about how can we have those metrics that would be trusted by governments and stakeholders. And I think that actually also lies at the heart of that question. It is when you can have these web that actually positively looking at stronger standards, not necessarily lower standards. That's when you actually have a chance of building those trusted and verifiable institutions and standards that will actually bring different stakeholders together, not tear them apart.
What about taxes for individuals or companies that are concerned about, issues like inequality or climate? I mean, can they still then, work to minimize their tax bills? But as you so often see, I mean, if you're thinking about the duty of a company in the old, Milton Friedman model, that is part of what they're supposed to do. And I think there's certainly going to be debates around fiduciary duty, but, thinking long-term, paying your taxes is one of the most important things to fixing a lot of these problems. And are we starting to see, that level of seriousness where it isn't just, oh, I'm going to put my money in this fund over that fund, but no, I'm actually going to take more out of my pocket to give back to the greater good?
I was going to say from a company perspective, I think you need the regulatory framework, obviously, to keep pace with the developments. So you need independent bodies setting, the targets and things that are outside of the remit of the government. So just as we have, I don't know, like Ofgem for the energy sector, whatever, you need these independent bodies so it doesn't just swing from one administration to the next. In terms of, you can definitely incentivize sectors, and governments have done in renewables, for example, giving them tax breaks to try and get them to invest more. That can be an incredibly helpful thing to do. You can do it by location as well, enterprise zones and things like that, when you're trying to regenerate certain areas or create jobs in certain areas to perhaps reduce inequality between different regions within a country. So there's a lot, I think, that you can do around that. Arguably, do you want to then do that at an individual level? You could, but then again, you get back to that measurement issue. If you're going to add, say, 1% onto everyone's national insurance rates, how does the government then prove that 1% is being put towards specifically sustainable projects? And that always comes back to it. But the idea is that that the tax pool that they're collecting should be being put forward to whatever the government feels is necessary for its economy and its society. And, we should be soon at a stage where that is including sustainability. It is not sort of an add-on. And I think that when we get that full integration rather than the add-on, I think it's when we get that big shift. And we've had a lot of this momentum has really accelerated as a result of the pandemic. And we need to try and make sure that we, as Bernice was saying earlier, capture that momentum. Don't waste the sort of guarantees that have been given or the incentives that have been given. It's surprising how often these things just sort of go into pots and then never actually get allocated. So we need to make sure that they get used. that the demand is there, and it needs to go through the whole chain, right? So as a consumer, we need to change the way we think, the way we behave, and what we consume. As an investor, we need to think about how we're allocating our money. You know, as a government, we need to think about what we want to be doing. As a regulator, we need to think about it. And it's only when you get all the bits together that you actually get the full impact of it. Otherwise, it's piecemeal and you don't get the same impact.
Sure. We've got some questions coming up in the audience. Thank you very much. Please keep those coming our way. I'll go ahead and turn to the first one now, and I'll come to you first, Amit, and then everyone else, please feel free to jump in afterwards. The question comes in and from Laura Kelly. It says, panelists have talked about demonstrating impact as important in getting investors on board. There are myriad sustainability indices and benchmarks out there, and good measurement will entail costs. What might be the way forward to build a way of measuring impact that investors and beneficiaries trust?
Great, Billy. And if it's all right with you, I might also start to touch upon the next question too, about who decides which metrics.
Sure. I'll go ahead and read that question too. So it says,
sure.
Who currently decides how to measure impact and which metrics to use? Is this role primarily with financial institutions? Who should be involved in deciding? So that one came in from Luis. So thank you, Laura and Luis. And Amit, I'll turn that over to you.
Sure. Yeah, I'll start off with Luis's point and then get to Laura's as well. I think, so a couple things that we think about is that, you know, one is to think about the measurements and the metrics. And then there's a whole bunch of services on top of which you can build. You know, ratings, indices, benchmarks, et cetera, analytics services. The way that the GIIN has worked is that we believe that the standards and the metrics should be public good, where everyone is using the same definitions when they think about you know, anything from, you know, how they have an impact for, you know, on climate, to how they think about more inclusive approaches to financial services, housing, sustainable agriculture, you name the issue, right? We want people speaking the same language. And then there's room for a variety of companies and endeavors to really be focusing on how do we kind of process that data in different ways to spit out kind of a rating or an index or other things. And that's where we see in the conventional financial markets, there's a variety of rating services, but we all generally use like GAAP accounting or IFRS to really understand the financial elements. So when it comes to who defines what matters, it's really important that it's a multi-stakeholder driven process. It wouldn't be appropriate just for investors to do that. It wouldn't be appropriate for just companies to do that. At the same time, those voices are important. The way we develop metrics with Iris Plus is we work with a whole bunch of other standard setters. Some of them are huge, like the OECD or UN agencies or the International Labor Organization, and some of them are deeply focused and targeted, going deep on like solar power or on specific elements of green real estate and so on. We work with over 50 different standard setters, but then we run a process. It takes a little bit of time to do it right, but where we develop metrics through engaging a variety of stakeholders, investors, companies, a variety of technical experts. They could be scientists or from think tanks. And then the metrics in Iris Plus, we also work to back them up with third-party evidence. And that's evidence that be coming from a university or from an institution like the World Bank, perhaps, or others, you know, that's been going deep on like what drives gender equality or what drives, you know, real impact when it comes to sustainable forestry. So we believe that stakeholder-driven process is important because ultimately, you know, who's writing the rules around impact is really critical to making sure that it does respond to a broader set of stakeholders. And so that's the methodology that we've both, kind of advocated for in the market, and it's what we've used in Iris Plus. If you're interested in going deeper on that platform, it's free, it's online. You can just go to the website of the GIIN or Google Iris Plus. It's IRIS with a plus sign.
Great, thank you. Does anyone have anything to add to that? No.
It was pretty comprehensive answer, I think.
I thought that was pretty good, but I wanted to give you a chance. We can move on to the next session. We have another one coming in from Fair Planet. From an impact investing perspective, are you satisfied with or confident that the shift toward investment or impact investing is happening with sufficient speed to tackle issues like climate change? Bernice, I'll let you take that one. What are your thoughts on that? Are we moving fast enough? Oh, sorry, looks like you're muted. There you go.
I think that almost the numbers speak for themselves, unfortunately, don't you think? That clearly at the moment, we are not doing enough as a global community to address climate change. And that would imply that the share that is played by investors and investments are also lagging behind, even though we are seeing more seeing improvements. And as we talked about at the beginning in the intro, where the market incentives don't align as well with the climate change agenda, we're not doing as well. So, you know, we saw this week that Exxon dropped out of Dow Jones. We saw obviously certain types of companies and shares are going up. We have priced a future expectation, but actually that doesn't, however, mean that we are really wholesale switching our practice in the same way. So then the question is whether or not, if they currently aren't doing enough, how do we make sure that they do, becomes the question that I'd like to ask. And, and my answer lied in what I said earlier in some ways, and if you don't want me going back to it, that, you know, ultimately we know that there are quite a lot of solutions that are being floated about, which is about cleaner energy, which currently the prices have come down. We need to move more money into that. Well, we know that there are areas such as, for example, negative emissions, which we need to do to affect what is so-called not just the flow for carbon emissions, but also the stock, so that we're moving them from the atmosphere that are currently too expensive and difficult. And this is where we will only see impact investment making an impact if there is an alignment with government to help drive down the cost and scale it in the right way. So I think that the answer is no, it's not enough. Can they do it on their own? Probably not, but we should never have expected that anyways. So therefore, the question becomes, how do we incentivize the kind of radical collaboration that we know we need? Now, in the darkest moments of COVID, a couple of months ago, in this deep darkness, there were a lot more discussions, if you recall, 5-6 months ago, about how do we really realign systems in a way that really change systems in a much more thorough way that actually lead to a very different way of life and very different way to think about where we live, how we build, and how we transport ourselves from one place to another. So I think that it is now time for us to take some of those lessons from that darkness that we have and translate them into market-friendly, but also government-friendly options that we can take forward so that we can find some answer to the question that we know that we're not doing enough to solve right now, especially, as I said, when it comes to questions not just around the flow of carbon emissions, but also the stock, moving them from the atmosphere in a way that is sustainable and also leading to more climate-friendly outcomes down the line.
Great. I think that's a great answer. And I think it was a great question. I think we can broaden that question out a little bit. I mean, you know, in terms of speeding up the pace of change on so many issues, climate change obviously is the most pressing, most critical crisis, you know, facing the planet. But it's not like we have a lot of time to fix some of these other issues. I mean, racial inequality in America is top of mind after, you know, what's happened this summer and this week. And it's getting to a boiling point where, you know, it's really kind of scary to think about, you know, if we maintain the status quo, where we end up after what happened in Kenosha, Minneapolis, around, you know. So I think the pace of change question is really important. And Bernice brings up a good point that it has to happen in conjunction with government. And I don't think I could ever disagree with that whatsoever. I'd like to get your thoughts, Amit and Carolyn as well, on sort of the pace of change around all of these issues that we are facing. You know, global health with the pandemic, and, you know, are we doing enough as individuals? You know, we need to pressure the governments, but we also need to take action ourselves as individuals and companies and investors, and with whatever levers of power we may have. And how do we make that speed up and be more effective?
Yeah, no, I appreciate the question and the challenge of this. And I think, you know, a couple of things I'd highlight. I think one is that, as you note, Billy, impact investing has been growing at a pretty, you know, tremendous rate. And we see it really booming all over the world. At the same time, when you zoom out to these bigger systemic issues, we're nowhere near where we need to be. You know, Bernice spoke a little bit about climate change, and barely, you know, any of the, you know, major industrialized nations are meeting their targets for the Paris Climate Accords. You know, just hitting the 5-year mark of that important 15-year agenda. Similarly, you know, in a few weeks' time, you know, the UN General Assembly will, I guess, convene virtually, but it's the 5-year review of the Sustainable Development Goals. And the indications are that we will also be falling well short of where we aim to be if we are going to achieve those really important, admittedly ambitious, but absolutely critical global goals. And I think that what's important for any investor or any kind of retail or institutional to be asking themselves is that these are big systemic issues. Things like climate change are kind of a byproduct of the system that we have, and it's very pervasive. So is the inequality that we see, and so is racial injustice. So as active participants in the system, it's very important, if we are going to correct these big systemic issues, that we take a systemic response to addressing them. And so we are, it's one thing that I think is really an important thing to note about this moment that we're in right now, is that I do think the pandemic and the multiple crises that we're facing, the global health crisis, the financial crisis, the climate crisis, and I'd argue a crisis of trust and confidence, do create the space for much bigger movement and leaps ahead. And I think whether it's the F2 Moral Money readers or the Conduit members or the members of the GIIN network, I think the real kind of opportunity for us is to make sure that we rise to this moment and this occasion.
Caroline, do you have anything you'd like to add?
Yeah, I guess just to add, if we think about the pace of change that occurred during the pandemic, it was phenomenal. If we said before that happened that the way you behave is going to completely change, almost overnight, you won't be doing this, you won't be doing that, you'll be wearing face masks, you'll be meeting people in a different environment, you'll suddenly be using Zoom even though you've never heard of it. I don't think people would have believed us. So it's a real example that actually change can happen a lot quicker than we think it can if we want it to. And I was going to say if we're forced to, which was the case for the pandemic. And this is the problem of the sort of the carrot and the stick. Do you try and force people through regulation, in which case the regulation needs to move a lot faster than it tends to kind of create that? Or do you create the incentives through the sort of carrot way, where you're pulling it from the demand side? And I guess you have to come at it from both ends to get the bigger impact and the faster impact. But there is an element, I suppose, we want to create, a faster acceleration towards sustainability trends than we've seen historically. But we do need frameworks in place, just as we've been talking. How do you measure it? How do you control it? How do you assess it? If you kind of run too quickly, you end up with all these little mushroom disparate approaches, and you don't get that systemic approach that Amit was talking about, that you really need to enact the change, because everyone will be running in their own different directions. So I do think it's a bit of a balance. Full-on speed is not necessarily always the best outcome, but clearly we can do things to accelerate and to learn from the crisis that change can happen really fast when we want it to.
Absolutely. That last question came in from Murat Sunair. So thank you, Murat, and thank you for writing again to clarify that. I want to make sure you have credit. We've got about 5 minutes left, and I know we need to do a little bit of housekeeping before we get out of here. So I want to just give everyone one final chance, sort of a lightning round type way to end this. We've covered a lot of ground here. I think we did a fair job of covering the state of the world in the time we had, and there is so much more. But coming out of the pandemic, you mentioned how we should realize now that the pace of change can accelerate. I don't think we want it to get to the point with the climate crisis that it got to with the pandemic before we make that change. We might already be there. I mean, look at what happened. Look at California and Louisiana and everything that's happened with the weather driven by climate change here in America over the past week alone. But on that, I'd just like to get your final thoughts on what is the most important thing coming out of COVID. Not that we're out of COVID by any stretch. That people that are Conduit members that are listening to this should take away from this. What can they do? What's the most important thing that they can do in terms of using their power, their influence, their money to improve the state of the world? And Amit, we'll start with you, then we'll go to Bernice, and then we'll end on Carolyn, and then we'll call it a session.
Sure. All right. No pressure. So I'll try to be brief, but I think ultimately what we're aiming to do is just the way if you think about all the energy and know-how that's put into driving better financial performance, we want to have the same thing also apply to impact performance, right? Can we drive a race to the top where we see competition around how we can achieve the greatest impact and how we innovate to advance what we're achieving individually and collectively? I think for the conduit and membership as well as your readership, Billy, it covers an immense kind of like a very powerful network of people. I think it comes back to something that Caroline said, that ultimately like everyone needs to revisit the way that they are investing, saving, spending, and working, and what we're doing with the various ways that we touch kind of assets and capital. Ultimately, I believe this is a question about how we define a new capitalism. How do we evolve a system that continues to drive great innovation and economic growth and opportunity, but also does so in a sustainable, fair, and inclusive way?
Great. Bernice, what are your final thoughts?
Well, I was thinking that, well, we don't have that much money to go around. Looking forward, it would appear, which means that every single penny we have, we need to make sure that it does everything that we need it to do. And now, what does that really mean? That means that we can't really afford to have hobby horses at the expense of others. And we do have to make sure that every penny that we try to invest in will do all the things that we would like. Now, what does that really mean? It means, as you might have gathered from what I said earlier, that we need to take a very maximalist approach when it comes to demanding social change. I think a lot about what put Mr. Trump into the White House, or what had done so certainly in the last couple of years. Looking forward, how do we learn lessons from the kind of investments that actually got him into the White House? That means what? That means investing not just in hard stuff, as I said, campaign money, but also some of the stuff around what we would consider softer stuff. Radio stations, we were talking academic analysis, conduit club perhaps is one of such, among other types of soft tissues that we actually together create that movement that we know we need in order to drive the different levels of shift. So I think a lot about how do we create what Caroline just mentioned in terms of the demand revolution that we need for the sustainability side. So I would learn from what has worked in the past and look at how do we actually invest in a maximalist way to connect all these pieces so that we really create the demand revolution that we need in order to drive that kind of wholesale change that we're all trying to aspire to right now. Thank you.
Excellent point. Caroline, final word to you.
Thanks. Put your money where your mouth is. If it's your ISA, if it's your pension, if you're a business owner, it doesn't really matter. Whatever money it is you've got, wherever you've got it, put it to good work.
Great. I think that's an excellent way to end this session. Thank you all so much for your time and your insight and your thoughts. This has been great. And with that, I will turn it back over to Emmanuel and the Conduit team to wrap things up.
Just want to say a big thank you to our speakers for tonight's discussion, and thank you all for joining. As mentioned, the recording will be available on our YouTube channel, so if you would like to go back and watch pieces of it, it should be up in the next few days. And with that, I wish you all a lovely evening. Thanks, everyone.
Thank you.
Thank you.